this is easy content. All this ERM stuff that we began last week. It's, you know, from what I've heard from people who have taken the BEC section of the exam, it's pretty heavy hit on the exam. So do keep that in mind as you're reading through it. It's easy. It's easy. It's boring, I guess, to me anyway. But it's easy stuff. I mean, you're not sitting there having to rack your brain out trying to understand it. It's just a matter of reading through it, kind of remembering things you need to remember, terms that maybe you need to kind of take note of. But all in all, this is pretty nice and easy stuff, and it doesn't take long to cover together. It's mostly just read it, understand it, you're good. The questions from each of the sections, the notes I wrote to myself are obvious, pretty much for most of them. They're all easy questions, not really worth talking out, I don't think. So yeah, that's good news. It's a nice break from some of the more complex things we do. Now, when we come back next week, we'll start number crunching again, financial management stuff. That's stuff you've probably seen before a lot. Valuation things mostly, kind of fun stuff. Time value of money again. You've seen it again and again and again. So we'll look at that. But yeah, it's a fun week next week. Not too difficult, but quick week this week. So let's go ahead and knock it out. So ERM and performance. I think maybe they retitled this section ERM, performance, review, and communication, but the content's exactly the same as it was before. But I think that's what they've titled this now. Am I right about that?
ERM is performance.
It is ERM performance still? Okay, I don't know where I got it. Maybe that was the old title, and I already updated it. Never mind.
What was the other thing you said?
The title it was before was ERM Performance, Review, and Communication.
Okay, review is on the next section, and communication is on the one after that.
Okay. Yeah, maybe that's why they retitled it. I think maybe they started putting it all in one section and forgot to change the title or something. Okay, so we're good with our title. Okay, so this is really just, it's hard to pick out where your test question might come from with a section like this, because it's really kind of broad stuff. It's like, hey, identify a risk. All right, where's my test question going to be on that? Identify a risk so you'll have a timely response. I don't know what they could ask about that. But they do throw a term at us that might be worth taking note of, a risk inventory, which is pretty it's a descriptive term. It's a list of all the known risks that a company has, maybe in nice, neat categories. Any risk that could impact whatever entity you're dealing with: economic risks, legal risks, demographic risks, society risks, whatever. It's just a list of them. This is just a systematic way of addressing risks and things. So once you've got your list of risks, then you start kind of ranking them in a way. How severe are this risk compared to this one and this one and this one? How bad of a risk are we talking here? How likely is it? And if it does happen, how bad is it going to be, right? And they throw some fancy-ish terms that describe a really simple idea. I don't know why they have to make it so hard, but you should consider your target residual risk is what they say. In other words, how much risk are we good hanging on to, right? And then figure out, that's where you want to be. Then figure out where you really are. And if you are not where you need to be, then you need to take steps to deal with it, right? It's just real obvious stuff. They mentioned a thing called a heat map, where you might, just kind of a pictorial way of displaying things. People like their fancy pictures and stuff like that. So this will be color coded and it'll show how severe certain risks are, whatever. I'm not into that kind of thing, but some people are, I guess. Prioritize them, give greater priority to risks that are likely to exceed the appetite you have for risk. We talked about risk appetite last time. And there's different criteria you can use to prioritize them. And I think the heaviest hit probably test area from this little section are these risk responses. So-and-so is an example of this response, that kind of question maybe. So things you can do, you can accept it. Yeah, the risk is there, whatever, we're fine with it. You can avoid it, try to get rid of it. You can pursue it. Like, okay, increase risk, let's go for it, and let's get in there and risk return, no guts, no glory type thing. Or you can reduce it, or you can share it. And that whole sharing thing, I've seen maybe more test questions from that, probably, if I can remember right. But sharing it is transferring a portion of it to someone else, like insurance or outsourcing or hedging your risks. So yeah, I highlighted those in green because I thought those were important takeaways from this section. And then they get fancy term again. All of this mess in number 5 is basically saying you want to manage risks to kind of align with your broad business objectives. So they call it a portfolio view of risks. So you're wanting to kind of big picture stuff. You're wanting to identify risks that are severe at the broad entity level. These are the ones that you want to identify and deal with. This full integration term they threw out, the portfolio view. That's the whole idea of the entity identifying and assessing risk at this very broad area of their business objectives and strategies and things. So, pretty light section. I didn't have any questions worth looking at from it, from the assessment questions. So just quick talk over it and keep moving, I guess. Way shorter of a section next. I just couldn't find a whole lot to get down on paper from this one. I think I just put that down so I wouldn't leave it blank. So they make the point that a company should assess substantial changes that occur, rapid growth, changes in innovation, changes in leadership, changes in personnel, and consider how that affects risks and things like that. It's the idea of monitoring situations and adapting, right? And also makes the point that you need to consider if an entity is taking on sufficient risk to attain their targets. So a couple of quick points here, not a whole lot to really talk about. No questions really worth spending time on. Communication and reporting. They talk about structured versus unstructured information. That's an idea that you'll see in the IT sections too, and something we're probably very familiar with. Structured is organized and searchable. Unstructured is disorganized, but it's better just to look at examples and then you quickly understand what they're talking about. Structured, staffing increases or decreases, population changes in the market, number of visits to a website, duration of time on a web page, conversions of website visits to customer purchases, that kind of thing. It's organized, it's searchable, it's got a structure. And then unstructured is just a little more random, like minutes of a meeting, emails, reports from the manufacturer, feedback on a product. Good information, but it's in a different format. It's unstructured. They make that point. I stuck that term data management architecture in there just because I thought, who knows. But then these last terms, there's that portfolio view again. Well, that should be on. Oops. Again, the idea of outlining risks at the entity level, the greatest risks to the big picture entity. Looking also, and it allows you to kind of look at the interdependencies between risks, and, as opposed to the more narrow focus, which is called the profile view of risk. I think test questions could come from those. That's the type of thing they like to ask. Easy enough. Portfolio, big package of things, profile, more narrow, more on the different levels within the entity. I think I've seen someone make an analogy like a Greek temple. The temple itself is like the portfolio, and then each individual column holding up the roof is the different levels. I don't know. I don't think we needed that analogy. It's a pretty understandable topic anyway. So that's it for that. Same with the questions. I didn't see any worth talking about. Fraud risk management. Fraud is a huge topic. I mean, we have an entire graduate course on fraud, so they certainly don't get into what all they could get into here. So the idea of managing fraud risk, they do define fraud. That's an important thing. Intentional is a key word here. If it's not intentional, it's not fraud. If it's not intentional, and it's a problem, it's an error, right? Fraud is intentional. So it's an intentional act or omission, not doing something. And your whole idea is to deceive somebody. And usually at a loss to the victim and a gain to the person doing it, right? We know what fraud is, but definitely pay attention to that whole idea of an intentional act. That is very important. Then they kind of go into different types of fraud. And this is good information too. This is like one of the first couple of weeks in the fraud examination course. But so you got reporting fraud, which is broken down into two categories here: financial and non-financial. Financial fraud, reporting fraud. I mean, it without us having to talk about it. We're cooking the books, right? We're misstating accounting information, usually overstating assets and overstating income, understating liabilities, understating expenses, but not always. The fraud perpetrator may have his eye on lowering their income taxes. So to do that, they would do the opposite of those things, report less income, so they'll pay less tax. So it could be the other way. But usually it's what you would expect it to be, overstating income. All right. Non-financial reporting fraud would be, again, manipulating reports, but things like environmental reports, health reports, safety reports, quality reports, that kind of thing. Misappropriation of assets is just stealing stuff. Anybody can do it. Employees, customers, hackers, they say. And then there's another category that's just other illegal acts, corruption. So we're talking like bribes, and somebody to do something, kickbacks, kind of entering into this agreement. I'll do this, you'll give me a piece of the action type thing. Illegal gratuities, that kind of thing. And that's about all they kind of go into. They really scratch the surface on here. They mentioned that COSO has some fraud risk management principles. It's the same old stuff. Control environment. That tone at the top thing is always an important deterrent of fraud and the other internal control things we've talked about. And they always make the point that tone at the top, the control environment, that is the thing that's the most important that kind of trickles down to all the rest, right? Fraud triangle is a classic thing. This is walking around knowledge you need to know. You need to know it for this test. You need to know it for the audit test. It's important. You need to know it for the CFE exam. So the fraud, and for the CFE exam, you need to know who came up with it, actually. You didn't do CFE, did you?
I didn't like that.
So the fraud triangle it's a guy named Donald Cressy, by the way. Anyway, fraud triangle is, these are the things that have to be present for fraud to take place. There has to be an incentive or pressure to do it. There has to be an opportunity to do it. And there has to be a way for the person who's doing it to rationalize that they are okay to do it. Incentive could be anything like this person has a gambling problem, and this person has a drug problem, or this person has numbers they're trying to meet. There's expectations that they meet certain numbers. And those are all incentives or pressures. Opportunity would be, I'm a manager and I can override this control. Or I've got my buddy down in the reporting accounting department and we're going to get together and game the system. Rationalization could be something like, our boss is crap and we don't like him at all, and he probably steals from other people, so we're going to steal from him. That would be a rationalization. Simpler would be like, everybody does it, I might as well do it, that kind of thing. Or rationalization could be, I'm only going to do this time, and then I'm going to fix it later. I'll never do it again, but I've got to get over this hump right now. Those are rationalizations. So that's good information the fraud triangle is. I grabbed a problem to look at here, just because I think I needed to grab a problem. I felt like I needed to. In a small public company, this is number 1 from this section, that has few levels of management with wide spans of control, each of the following mitigates management override of controls except what? So management override of controls is an inherent limitation that we've talked about. It's one of those classic things it's an inherent limitation of a control system. There are ways to mitigate it, and they give us a list of 4 things, and they say which of these does not mitigate management override of controls. So A says, establishing an effective and anonymous whistleblower program in which employees can feel comfortable reporting any irregularities. That would be a good way to mitigate potential management overriding controls. If somebody kind of catches wind of something and overhears something, they have a way to report that anonymously, and that would be a good control to have in place. So A is fine. B says establishing a corporate culture. You can stop there. Well, you can. They might throw something there. A culture where it's okay to steal. So I guess you should keep reading. Establishing a corporate culture in which integrity and ethical values are highly appreciated. That's that whole tone at the top thing. If you respect the people running the business, you want to treat them better, right? C says having 2 officers who significantly influence management and operations. All right, so that's a red flag. You've got these 2 officers who are really running the show, maybe kind of unchecked. That can lead to problems. And this is all about management override and control. So this would be a potential problem right here. If you got these 2 people who are so deep into everything, can really do whatever they want. That's a problem. And obviously, B's fine, having an effective internal auditor function. That's a good question. Easy question, but it's a good question. Okay. That's all I got from it. All right, moving on. Okay, Sarbanes-Oxley is important. this is also for us as accountants, especially auditors. This is kind of walking around knowledge too. You know, Sarbanes has been such a big thing and has done such a lot of, had a lot of changes come about because of it. And there's just, these are the kind of the classic things that we know Sarbanes has done and accomplishes, and it's good test material. Probably more so for the audit section of the CPA exam than the BEC, but they put it in here, so there's overlap, so it could be important for BEC too. So we probably know all this. Sarbanes applies to audits of publicly traded companies, right? Well, we'll make that wrong because management has responsibilities under Sarbanes, kind of independent of the audit, I guess. So one of the big points they make in Sarbanes is that CEO and the CFO, historically speaking, they're going to be the ones involved in this fraudulent activity. So they kind of have special things that the CEO and CFO have to do. So that's a big thing. And they kind of talk about audit committees for a second, then they get back to the CEO and CFO. So audit committees, that's a big deal in Sarbanes. Audit committee has a lot of power. They choose the auditor of the company. They compensate the auditor. They oversee the audit function, and they have the power to terminate the company's auditors. Who doesn't do that is the CEO or CFO. It's important. So we're trying to keep the CEO and CFO kind of separate from the audit function there. We don't trust them. Audit committees must be independent of the company, and at least one member of the audit committee has to be a financial expert. Now, the CEO and CFO, they are officers of the company, right? Chief Executive Officer, Chief Financial Officer. So the officers have to certify the financial statements. That gives them additional accountability. So they have to sign off on these things. They have to certify that it is accurate. And they have to certify that they've reviewed the reports. And to their knowledge, there's no materially untrue statements. And that the financial info is fairly presented. All right, this puts, there's legal ramifications to this. So this kind of puts them in, if that ends up not being true, they're in big trouble. They've certified that, they're lying at this point, right? This puts stiffer penalties on them. So that's why they have to do this. There's legal ramifications to them doing this. They also have to certify that they've reported to the auditors any significant deficiencies and any material weaknesses in controls, any fraud, regardless of materiality, that involves management or other employees that play a significant role in internal controls. So they got to be upfront and honest about all this stuff, or they're in for it. They define clawbacks. I don't know how important this is, but it's a term we hear. So clawbacks are if they find the financial statements have been materially restated as a result of misconduct, CEO and CFO have to reimburse the company for bonuses received due to that misstatement and any profits they received from selling company stock during that period. And then the rest of it's like, just kind of randoms. There's provisions in Sarbanes regarding off-balance sheet transactions. A lot of this came about because of Enron, and Enron was big on the off-balance sheet things, so that was a response to that. There's a big deal about improper loans from the company to the officers. There's provisions about not destroying records, and audit documents are required to be maintained for 7 years after the audit's done. There's whistleblower protections in there. And then finally, it established our PCAOB, which puts forth the auditing standards regarding an audit of a publicly traded company. So this is good walking around knowledge, stuff you need to know. Stuff you probably know for the most part anyway, right? Questions from it. So I got number 9 and number 10 off of this one. I don't know why I did. They're so easy. I think I just, we need some questions to look at. We haven't had many. And this was, I think I got this because this was an AI CPA question, which means this was an actual old CPA exam question. So maybe making the point that not all these CPA exam questions are going to be hard. Which of the following organizations was established by Sarbanes? PCAOB.
I thought it was a trick question.
It's so easy, you thought it was a trick, right?
That's how I felt on par too. Like when I got the 2 questions, I was like, something's wrong.
Mm-hmm.
Not what I'm thinking.
Yeah. It's important to know that they're not trying to trick you every time. So, yeah, when they're so easy like that, it makes you pause, doesn't it? This is a long one. So, which of the this is an AI CPA question too. Which of the following situations most clearly illustrates a breach of fiduciary duty by one or more members of the board of directors of a corporation? All right. So these fiduciary duties, duties that the shoot, I can't think of what the fiduciary duties are. There's 2 of them. Duty of mine's gone blank. Duty of care and duty of why I gone blank on that. Gotta look it up. If I don't look it up, it'll come to me eventually. But duty of care, duty of loyalty. Yeah, that's it. So the fiduciary duties are duty of loyalty. They're supposed to be loyal to the people they're supposed to be loyal to. And duty of care. They're supposed to exercise care and carrying out things they're supposed to carry out, right? So which of the following would be a breach of the duties they owe to their stakeholders? A says a corporation previously has distributed 50% of its earnings as dividends. This year, it has annual earnings per share of $2, and the board of directors voted 4-1 against paying a dividend. Is that a problem? No, you don't have to pay dividends. There are some companies that have never paid dividends. So there's no duty to pay dividends. So we're okay with A. B says a director who co-owns a computer vendor negotiated the purchase price of a computer system by the corporation from the vendor. Okay, so far it's looking a little sketchy, but look, they made full disclosure about it. It was a competitive price, and the board unanimously approved it. It's all above board. Everything's fine. This is good. There's conflicts of interest, but those are not a problem. That type of thing's not a problem as long as it's disclosed, right? So we're cool with B. C says 2 directors of a corporation favor business expansion and 2 oppose it. And a 5th did not attend the meeting. During the 5 years the 5th person has been a director, the individual did not attend 2 other meetings. All right, if I'm reading this, I don't like it, but I'm thinking there may not be a duty breached here yet. So depending on what D says, I'm hanging on to that one. D says a director who learned that the corporation is thinking of buying retail space in a city personally purchased the vacant building in the same city that would have been suitable for use by the corporation. That's a problem. That is not a duty of loyalty. You are not being loyal to your stakeholders. You're looking out for yourself. So D is the big problem. We don't like C either, but D is obviously This is a big problem. C is just kind of like, they kind of stink. They need to do a little better. But D is clear. So, good question. All right, I think that wraps us up on ERM. Nice and quick. So this enters us, just barely enters us into financial management. I find the financial management portion of the BEC exam to be one of the easiest things. I find econ to be probably the most challenging, just because that's not my background. And I find IT to be challenging just because it's like, what the heck do I need to focus on here? That's the hard part about IT and ERM too, I guess. Financial management, though, there's no mystery about, oh, I need to know this, and here's how to do it. Econ's the same, it's like, I know what I need to focus on. It just kind of wears me out having to think through it all.
So hard.
It's kind of hard. Yeah, it's just kind of hard. It just is. IT's hard because it's like, I don't know how important any of this is, and it may all be important. So that's the tricky part with IT. But yeah, financial management, no mystery about what's important, and it's fairly easy. So let's do it. So they have a little introductory section that really doesn't have much content, and then we get into the section that is cost concepts that does have good content, some of which we've already seen, most of which we already know. So we know what a cost versus an expense is. We're accountants, right? Cost is what you pay for something, but we don't expense it until we use it, right? So we know that. That's principles of accounting stuff. They do make the point that a cost and an expense can occur simultaneously. We obviously know that. In the long run, I thought this was a neat thought. I really thought of it this way, but in the long run, over the life of a resource or a business itself, all the costs will equal the expenses. They'll all get expensed eventually, right? All right, sunk costs we've talked about already, so we don't need to talk about it again. Same with opportunity cost. Incremental cost, we've actually talked about that too when we were doing those special order decisions and that kind of thing. So differential incremental costs. We've talked about all this. I don't know why they're sticking in this section again. There it is. All right, so cost of capital and weighted average cost of capital. This is the big deal here. This is where we're going to have to do our number crunching. It's so easy. And we've already talked about cost of debt. So remember that we have an interest rate, but our overall cost of debt is less than that stated interest rate, right? Because we get a tax benefit from the fact that we can deduct those interest expenses. So the true cost of debt is that rate times 1 minus the tax rate. So we've talked about that. We're going to use that a lot in this little section as part of a larger problem of figuring out what our weighted average cost of capital is. All right, so we'll do that in a minute. Cost of preferred stock and cost of common stock. We'll get into that in a minute too. But really what most of your problems will be is what is the cost of debt, might be a problem, or what is the weighted average cost of capital given this set of circumstances. So cost of preferred stock, they talk about how preferred stock has a characteristic of debt. Dividend rate paid before the common stockholders get theirs. But it also has characteristics of equity because there's potential claim to additional dividends and claims on assets and liquidation and that type of thing. at this point, when we get into valuation a little later, we'll deal with a little more figuring out this type of thing. They're just going to give us numbers for these problems on the cost of stock and things, though. So they make the point that the cost of any of these sources is based on the opportunity cost in the capital markets. The return investors could earn from the best available alternative of comparable risk. The market determines these things. But based on what we know, we're going to be able to calculate a weighted average cost of capital. And that's really, when we start doing all this time value of money stuff, that's a lot of times that's what that discount rate is that we're using. So this is what goes into us figuring that out. So I have little notes about how it's done, but it's really easier just to get in there and do it. So let's do it. There's 12 problems from this chapter. I got all 12 of them for us here to look at. I thought they were all worth looking at. You'll see how easy it is. Well, you've already seen how easy it is because you've already done it, but all right. So number one, they're wanting to figure out what the weighted average cost of capital is after tax. So we got to apply that we get a tax deduction for the cost of debt. So here's all you do. We've got bonds that make up 40% of our capital structure. Those have a 10% essentially interest rate attached to them. The cost of capital attached to those is 10%. Common stock has a cost of 10%. That makes up 50% of our structure. And then preferred stock has a cost that costs us 20%. That makes up 10% of our structure. So given all of that, what is our weighted average cost of capital? So here's all you do. You got a cost of debt. It's 40%, but we got to adjust that for the fact that we get a tax benefit. Our tax rate's 30%. So after that deduction, it's really 7% after tax is what that costs. So that's a real important thing to know how to do. And honestly, the hardest part about this problem, if there's anything hard about it, cost of common stock, they give it to us. We don't have to figure any of this out. %. Cost of preferred stock, they give it to us. We don't have to figure anything out. So we got the after-tax cost of the debt. There's no tax benefit to paying dividends and things like that, so we don't have to adjust the common stock and things for tax benefits. Apply the weights. This is 40% of your capital structure. This is 50%. This is 10%. Multiply, add, and then you're done. So 2.8, 5.0, 2.0. So our weighted average cost of capital is 9.8%. There you go. That's it. So that is when we're trying to value a company or something like that. That would be our appropriate present value number to use, the weighted average cost of capital, because the company is made up of that capital structure. Now, if we're discounting back and try to put a value on bonds or something, we would use the cost of debt number. So that's it for number one. Easy little problem, no problem. All right, same thing on number two. you got to work with what they give you. They don't tell you a tax rate, so I guess we just have to assume that they've already given this to us after tax, or they're asking for a before tax number. I don't know. So a company has the following financial information: long-term debt, preferred stock, common stock. There's the cost. There's the portion of its capital structure. So as the company's considering projects to undertake or not undertake, capital budgeting type things, what do they want to accept? Projects, what's their kind of hurdle rate? We'll do all that net present value stuff later in the semester too. This is the hurdle rate that we would be using. All right, well, this is real easy. They've already got it set out for us. We just have to multiply this stuff together and we're done. So the cost of debt is 7.1%. Multiply that by 60%. It's 4.26. Cost of preferred stock is 10.5%. Multiply that by 20%. It's 2.1. 14.2% cost of common stock. 20% of your structure. 0.84%. Add them all up. 9.2. There you go. So all those net present value problems you've done in the past, where you had to discount stuff back, that's where that discount rate comes from. The weighted average cost of all your debt and equity. Pretty easy stuff. Okay, let's shift gears on us a little bit. For number 3, this is so easy. It's one of those. It's like, am I doing this right? For the year ended 2004, the company incurred direct cost of $500,000 based on a particular course of action during the year. If a different course of action had been taken, direct costs would have been $400,000. In addition, their fixed costs were $90,000. What was the incremental cost? I mean, I think they're just wondering if we know what incremental cost is. They did a $500,000 thing. It could have been a $400,000 thing. It was $100,000 more, right? That's it. Fixed costs are the same under either of these choices. So one choice is $100,000 different than the other. That's the incremental cost. That's the difference in the two alternatives. It was just that easy. Okay. A lot of words. Really, all you have to read here is this last sentence to answer the question. The new machine, in deciding to replace an old machine, which of the following factors should they not consider? We don't care what the original cost of the old machine was. That's a sunk cost. So that is not relevant. So there you go. Their decision is, should I keep the machine or buy a new one? Salvage value of what they're thinking about getting rid of would differ between the two alternatives, right? So there you go. Okay. I guess you might have to think a little bit about C, but that would be varying, obviously. It's going to last you another month, or it's going to last you 10 years. That would certainly factor into your decision, wouldn't it? All right, number 5. Which of the following statements is correct regarding the weighted average cost of capital? A says one of the company's objectives is to minimize the weighted average cost of capital. Well, why the heck not? It's a cost. Of course they want to minimize it. That's the answer. They can minimize, it's like, hey, I would like to reduce the interest I'm paying on debt. Be a good thing. Would reduce their weighted average cost of capital. Number 6. Okay. So they're wanting to know what the opportunity cost of something here is. All right. So, like I said, I always read the last sentence first just to know what I'm looking for and to get my mind right. So opportunity cost is the cost, or the benefit you're foregoing by choosing one alternative over the next best one, right? So, all right. So reading through this, Carter Company paid $1 million for land 3 years ago. They estimate it could sell the land for $1.2 million net of selling costs. If the land is not sold, they plan to develop the land at a cost of $1.5 million. They estimate net cash flow from development in the first year of operations will be $500,000. What is the opportunity cost of the development? This one takes a minute to kind of get your mind right on. So that last sentence says, what's the opportunity cost of the development? So that tells us that they chose to develop the land, right? So what did they give up by not doing the next best alternative? So this is what they did. This is what they chose not to do. And the opportunity cost is $1.2 million. It's kind of a weird question.
I think my brain interpreted that the opposite way.
Yeah, I can see that.
Because I know I got this one wrong. It's just, I think the wording.
Yeah, it's a weird question. What are they?
I see it now that you explain it. But
yeah. What are they giving up by not doing the next best alternative? Yeah. It's weird. It's a weird setup. It really is. But there you go. 7 I like. It took a little bit of thinking. All right. A company uses a company-wide cost of capital, weighted average cost of capital like we've been calculating, to evaluate new capital investments. Think of it as a hurdle rate. It's like, okay, 10%. That's the company-wide. They're saying anything above 10%, go for it. All right. What is the implication of this policy when the company has multiple operating divisions, each having unique risk attributes and capital costs? So you got high risk or low risk divisions, but they're each using the same weighted average cost of capital. So you kind of have to think in your head, okay, if they were doing a better, more thorough job with this, the high risk division would probably need to have a higher, there would be a higher cost of capital associated with it, higher risk, higher cost, right? So the higher risk division is making decisions based on a lower cost of capital than it should be applying. So that means that they're going to overinvest, right? They're going to be looking for projects that yield 10% or greater when they should be looking for ones that yield 20% or greater because they're high risk. So what was the answer? High risk divisions will overinvest. Low risk divisions will underinvest. That's the answer. We kind of took the point of view of the high risk division. So the low risk division really would have a lower cost of capital, but they're only looking for these 10% when they'd actually be probably making money doing a 6 or 7% return. That's a pretty good question. Number 8. Good one. Which of the following is assigned to goods that were either purchased or manufactured for resale? Why they're asking this at all. I don't know. It's product cost. This is just a question that's out of place. Here we are back with calculations again. So they have attached dollar figures to this that mean nothing to us. The only reason these would mean something to us is if they didn't give us this column. If they only gave us the dollar numbers, we could have figured out these percentages. That's what we need to keep going, right? But they did, so we don't really need it. So really all we're doing is same thing we've been doing. are taking 30% times 8%. Oh wait, no tax rate to fool with. So, yeah, they don't give us a tax rate. We don't have to adjust cost of debt. So that's not part of it. Wait a minute. No, they don't give us the debt. They don't give us a tax rate. Okay, just making sure. All right, so multiply it out. 30% times 8% is 2.4. 10% times 10% is 1.0. 60% times 12% is 7.2. Add them up. Done. Gotta love these. Nothing to it. All right, number 10. I like 10, I think. Which of the following correctly states relevant costs when making a decision whether to replace a delivery vehicle? All right, so let's read the rest of it. Management is deciding whether to replace a delivery van. So keep it or replace it. We can buy a new one for $40,000 to replace the old one. The old one cost us $30,000. It has accumulated depreciation of $20,000. An employee has offered to buy it for $12,000. Which of the following correctly states relevant costs when making the decision? All right, so we're looking for a list of things that are all relevant. So A says purchase price of the new van. Yeah, like that. That's in every answer choice, so we know that one's relevant. Disposal price of the old van. Yep, that's, if we keep it, we don't get that. If we dispose of it, we do. Gain on the sale of the old van. What do you think about that? What is a gain? It is the amount received minus book value. Book value, if you remember, is original cost minus accumulated depreciation. Right? That's your gain or loss. It's an accounting number, right? It just reflects us getting rid of something and offsetting it by the book value. It's an accounting bookkeeping number. So, it's not relevant to the real decision. We're not making whatever that gain is. That gain's based on 2 sunk costs as well, right? The original cost of it and the systematic depreciation that we've recognized over time. So that's not relevant. So we're good with this, but not that. Okay, in B, we're still good with the purchase price of the new van. We don't care about the purchase price of the old van. That's a sunk cost. C, purchase price of the new van, disposal price of the old van. That's interesting to us, right? We already said that up here. So both of those are relevant. We're good. Let's see what we got here. Purchase price of the new van, purchase price of the old van, no. Depreciation, no. Gain, no. Disposal price of the old van, yes. Okay, so we found the one that contained only relevant costs, right? So C is the answer. Okay, it's a good question. Number 11, which of the following statements is true regarding opportunity cost? A says opportunity cost is recording in the accounts of an organization. No, that's what an opportunity cost is not. They don't go into our accounting records. They're good for internal decisions, but they're not in our records. B says the potential benefit is not sacrificed when selecting an alternative. So that's kind of a weird wording. What are they saying here? Okay, but yeah, B doesn't work. C does. Idle space that has no alternative use has an opportunity cost of 0. That's true, right? You know, if you have idle space and you can't do anything with it, there's no opportunity cost there. You know, there's no benefit of choosing to do something else. So there you go. And no, opportunity cost is not representative of actual dollar outlay. But yeah, back to B, when you select an alternative, you are sacrificing some potential benefit, right? Okay. Last one. Opportunity cost again. The company had a choice between project X and project Y. Net present value of X is $1 million. Net present value of Y is $750. Company chose X. What's the opportunity cost of that decision? Is the benefit you're giving up by choosing one decision over the other. So it's essentially what's the cost of the next best alternative, or what are you giving up from the next best alternative? So you are choosing this. You are giving up this. So you are giving up $750,000 by choosing project X. That's opportunity cost. If project Y had a $0 value, you have an opportunity cost of 0. The same idea as 11 here. There is no opportunity cost of choosing X if there's no alternative, right? So there you go. Those are all good questions. Well, most of those are good questions.